Hello and welcome to the Kingsview Investment Management Q3 Market Update and Portfolio Review. My name is Scott Martin, Chief Investment Officer and Portfolio Manager at Kingsview Investment Management. Joining me today, a familiar face, Paul Nolte, Portfolio Manager and Senior Vice President at Kingsview Investment Management. Paul, as always, out of your busy schedule, taking some time for us today. Thanks for joining us.
Nice to be with you again.
Yes, it is, and nice to see that summer is here after a long winter here in Chicago, where Kingsview Investment Management is based, if you wanted to know, and also a very lackluster spring, if I may say, weather-wise,
Absolutely.
as far as warmth. We did have a lot of rain, though, so definitely good to join you here in July with some of the weather finally turned. And frankly, some of the stock market weather a little turned lately as well, I think, turning the heat up a little bit on some new record highs. Paul, do you want to talk a little bit about some of the index's performance and what we've seen, especially most recently in Q2 and maybe even the start of Q3? We're just filming this about mid-July or so. Let's go into the markets and how they've been performing and behaving.
Yeah, and really, we'll keep the weather reference going. May showers did bring the June flowers, so we had a very lousy May. June came out and erased all of those May losses, but really for the quarter, it was April. So the April return was pretty much the return for the quarter, but the momentum has continued, and a lot of that, I think, has to do more with the Fed than it does anything else at this point. I think that markets are really keeping an eye on the interest rate environment, what the Fed is going to do, what they think it's going to do. And really, when you take a look at it, the tariff talk has moved to the back page. We're not hearing good, bad, or indifferent. The focus right now has been on the Fed, and low interest rates is the word of the day.
Well, the tariff thing's interesting because it seems like every other day we get good news and then bad news, good news and then bad news. But to your point, back in the day, and now what's funny is the tariff stuff has been going on now, if you're keeping track, over a year now, over a year and 6 months roughly. And it seems like the markets, to your point, have really started to digest any news that comes out on the tariffs. I mean, some of the news that would come out that was poor on the tariffs, maybe we weren't getting along with China, would knock the S&P down 20 points just like that. Nowadays, 2, 3, 4, 5 points, and then it rallies to your notion there. So with that said, Paul, does that mean that what we're seeing a lot in the market action is pertaining to maybe the Fed, as we just saw recently this week, being back in play with maybe some interest rate cuts and other stimulative measures?
I think so, because really when you take a look at the economic data has been okay. It's not terrible, certainly not recessionary or warranting a rate cut from that perspective. We look at the inflation numbers. The inflation numbers haven't changed too terribly much. We're 2%-ish, 1.5%, depending on
what you're buying.
What you're looking at,
Yeah.
whether it's a PCE, trimmed mean, or any of the other ones that they may look at. We're still in that 2%-ish range. And we have the markets at all-time highs. And we normally don't see a Fed that is willing to cut interest rates in that type of an environment. So there's something else that they're looking at. And my guess is, in a very cynical way, they're looking at wanting to keep the equity markets on the high side and going higher. So that's kind of their third mandate, is to keep the equity markets happy. And they're doing it by keeping interest rates low so corporations can borrow, buy back stock, as they've done for much of the last 10 years.
I love how you put that. Third mandate that has probably leapfrogged the other two, which is price stability and maximum employment, because it seems to me like the Fed does care quite a bit about equity prices. That's the interesting thing too, Paul, though, is as we hear from the administration in D.C., this is one of the greatest, if not the greatest economy ever, yet it needs rate cuts. But here's the weird thing that I've been thinking about a lot this week, and it's frankly been, well, not keeping me up at night, but it may. It seems to me, Paul, though, that now that we have Fed Fund futures pricing out rate cuts this year, Fed Chairman Powell acknowledging that also earlier this week, but now it seems like rates, and it's early in the game, feel like they've got a little bit of a bubbly feeling now. Is that something to be concerned about if we see rates back up amidst a Fed that's cutting?
I think it does, and here's why. We came into this year with the expectation we were going to be hiking rates another 2 to 3 times.
Yeah.
That changed dramatically after the new year. Now we're looking at rate cuts. We had as many as 4 rate cuts, first one being 50 basis points. Now we've backed off that, priced in. Now we've backed off of that. And I think the markets are looking for something. It's the shiny new toy. So we're worried about 3 increases. Now we're worried about 2 cuts, and we need more rate cuts in order to make things go. And when you look at the economic data, it's still okay. It really doesn't warrant that. And we're not even feeling the effects yet of the increase in December. Here we are in July. Normally it's 6 months at the earliest. Usually it's 12 before we really see that impact. We're already taking away that rate increase.
And that may be the interesting point for the equity markets too, is the next Fed meeting, by the way, is July 30, or what is it, I guess 30th, 31st. Yeah, this is a 2-day meeting. And what will happen is, I still believe we're probably going to get a rate cut there. I think maybe 25 basis points. But that effect, to your point, is not going to get into the equity markets. Maybe it'll get in the equity markets first, but certainly not in the economy for months to come, if not quarters to come. So if the Fed is indeed looking at economic data, as they say they are, famously, they're going to continue to cut because they're probably not going to see data affected very well until those rate cuts are actually felt. And that's the other weird thing, is that you mentioned some of the hints in the economy and stuff that we look at Kingsview Investment Management to drive the portfolio allocations we make, Paul. I mean, GDP, look at core PCE, things like that. We look at consumer sentiment, jobs reports. Those data points, if you could just elaborate and dig more into those, to your point, have been okay. There's been nothing to write home about, but there's also been nothing to cry home about either. So how are those looking out for you, especially when maybe it comes to employment?
Well, I mean, when you take a look at, if you're worried about something, it's manufacturing. So the global PMIs have certainly come down. They're now below 50, and that's the magic line. Services are still above 50. They still look okay.
ISM services?
The ISM and the market.
The manufacturing index,
the
and
market
the ISM,
PMIs.
non-man, okay.
So when you take a look at that, if you take a look at a lot of the other data points, again, they're okay. The employment report this last month was
nice bounce back.
Was pretty good.
Yeah.
On average, we're up about 1.5% above where we were a year ago, which is not bad. Wage growth continues to be in that 3.25% range. Again, midpoint of its historical range, so those are good points. And the thought that we're going to get inflation up by cutting rates, I think the last 10 years has probably bounce that out of the textbooks. So I don't know if
depending on who's writing them.
We don't. And the rate cuts, I don't think are going to do anything for trade, which is really the biggest concern. What we're hearing from corporations, and we're going to get a lot of it in the next 2-3 weeks, is the uncertainty around trade. And that the Fed is not going to fix by cutting rates.
Great point. You reference trade because as earnings reports come out, earnings season starts in earnest next week with banks, and then you've got some more manufacturers, and then obviously into tech. And you're right, a lot of tech companies doing a lot of business in China and overseas, Paul. They definitely are probably going to start commenting about how trade's affecting them. And very prescient point in that cutting interest rates doesn't fix the tariff wars. It does not fix the trade imbalance. So it's strange, I agree, that the Fed seems to be being driven by some of the trade issues and some of the tariff wars, but they can't affect that stuff really. So that's an interesting take that they have. Another part of our portfolio allocation that I think has been really beneficial and interesting, and things that you and I have taken a main lead in directing this year, especially, Paul, has been some of the alternative stuff we've done. Whether it's been gold or things with currencies. Let's talk about gold a little bit, because gold has been, let's say, a sleepy metal for some years at times.
Decades, yeah.
But now, I mean, in the last few months, it's been kind of a portfolio's best friend to some degree, as have some other alternative asset classes, because of the non-correlation value and some of the low volatility it's provided some of those portfolios.
If you take a look at how gold reacts in the marketplace, it has been over the last decade to 2 decades really an anti-dollar play. So if the dollar is strong, gold has been weak. And certainly as interest rates have gone up over the last year or so, it gets more expensive to hold on to gold. So now with talk of cutting interest rates and the dollar weakening here a little bit, I think it's providing some impetus to gold. Whether that's a short-term, long-term, yet to be seen. But we've cleared a few hurdles right now, which have been really caps to gold, and we're now starting to see that run here a little bit. So again, some of the changes that we've talked about in the past, we're still in play on. We still do like value.
Yeah, I was going to ask you about value versus growth. Talk about that widening gap. Stretching of the rubber band?
It absolutely has. And when you look around the world, the best asset class has been the S&P 500. So anytime you've gone away from the S&P 500, it's actually harmed performance. that's something that we don't think is going to be persistent forever. And so we're starting to move portfolios away from that, anticipating it as opposed to reacting to it. And I think that's the same way with gold versus value at this point. Value is
growth
underperforming.
versus value, yes.
Growth has continued to dominate. This last quarter, the top 10 names in the S&P 500 accounted for over a third of the performance. So again, very, very top heavy. But that's something that does not last in a long term. And it's not something that we're really wanting to try to play over the short run. We're trying to play a long-term game here. And it makes sense to be looking at those cheaper parts of the market.
And I would venture to say, Paul, growth being an asset class that has benefited from a falling open market interest rate environment, which, again, not to make the call here and today, July 12th or whatever it is, that this is the bottom in the rates, but just that we're seeing some interesting reactions. I mean, we had a recent bond auction that was not good after the Fed came out and talked very dovishly in their recent commentary. So it's just some interesting things that are kind of going on, interest rate sensitive sectors taking it out in the chin a bit. The last thing I'll tell you is let's talk about international equities for a little while, just because of the fact that, look, everything's interconnected. We like it or not. Emerging markets, foreign developed markets, S&P 500. What are you seeing overseas that's cause for, let's use a word, exuberance or concern when it comes to some foreign positions that may be out there?
The biggest concern that we have internationally is certainly China, and China has been leading emerging markets lower.
Can you believe China's still an emerging market?
Well, I mean, they're moving. They're getting much more exposure in the emerging market area, so they're a bigger percentage of a lot of the indices. So when we take a look at that market, we want to be kind of shying away from that market. The beneficiaries, surprisingly, are Taiwan, Vietnam, as trade now moves through some of those countries. Again, emerging markets, and some might even consider frontier markets. So those, I think, continue to be extremely cheap. I think they're going to be dependent on a trade deal. Without a trade deal, they'll do okay. They were up 10% in the first half of the year, which is a great first half of the year. Again, compared to the S&P, not as good.
And more standard deviation, i.e. volatility. So I talked about things that keep me up at night. Those are things that I'm sure can keep others up at night, given the fact that you get that run, like you mentioned, the 10% or whatever it was, but you're getting a bumpy ride too. You're getting a bit of a bigger roller coaster. And if you like roller coasters, there's a good place to be, I think, if you do.
But we point to the fourth quarter where the equity markets fell apart and emerging markets did relatively well. So again, when we see those types of things occur, those are some of the cushions that we'll have in the portfolio.
Over that time, your bond positions did well too in Q4. Something to keep in mind if we do get any equity market corrections here, what do bonds do in response to that? Well, look, I think that's good for today, Paul. Thanks again for taking time out of your busy schedule, and thank you for joining us today. If you have any questions or thoughts about what we shared today, please reach out to your investment advisor, or you can send us an email directly. You can reach us at ic@kingsviewam.com. Thank you again for joining us.